Right, welcome back. This new tool that I'm going to teach you today is something that will be valuable for the rest of your life. So listen very carefully and watch this from beginning to end. Pause it when you need and go right over from the beginning if this is necessary. Today we're going to talk about manage your money like the rich. How many of you would like to have a simple formula to financial freedom? How many of you have lived in families like mine where there were split mentalities about money? Would you know what I'm talking about at all here? Like, mom had a certain way of thinking and my dad had a completely different way of thinking. So my parents got married at 20 and 23 with zero knowledge of money management. My dad was fun-loving. He worked hard, played hard. So he worked as a cash van driver at the local bank, and my mother brought up three very naughty kids. Well, two very naughty kids. That's myself, the eldest, and my sister, because the youngest was really a very good girl. And my father used to get paid every 25th of the month, and invariably he would bring the salary home, give it to my mother, and my mother became the family administrator at the grand age of 21, 22. And he would keep a little part of his salary as his pocket money or beer money, whatever it is he wanted to use it for, right? So my mother was the principal money admin. My father worked hard, but at the end of the day, he always met up with the boys, had a couple of rounds, then would come home, and then that's how life was as I was growing up. So, but I remember he used to bring the salary in on the 25th of the month, but I remember every 20th of the month, he would go back to my mother and borrow back some of his beer money, which he would give her back on the 25th when he got his salary. Now, she would lecture about that, but she always had the cookie jar, the nest egg, and she would pull out that uncomfortable $10 and give it to him as long as there was the arrangement of the give back. Needless to say, money was always a subject that was very creative at home. Later, when I was growing up, I had turned 13, my sister had turned 10, and my mother said that it's time to learn budgeting, so she was starting to give us some pocket money so that we could use for our stuff that we shouldn't ask for anymore to our parents. So we used to get the equivalent of maybe about $10, which should have lasted a month. She told us to use this money very wisely so that it would last till the end of the month. As kids, to be honest, we really didn't need much, but, you know, as two kids growing up, we already had very split mentalities about money. So I took after my mother and was very wise very quickly, and my sister would invariably come to me to borrow $1 before the end of the month. So I would lend her this money, but ask for a 10% interest, 10 cents. I would ask, I'll give you $1, but I want 10 cents for me for giving it to you. She would take this money and grumble a little bit about it, and when, you know, the next pocket money time was due, I would tell my mother to make sure that she gave me her $1 so that there would be no argument. After 10 months of loaning her this money, I started loaning her own money and still making some on it. I guess today I'd be called a loan shark. I ended up working in a corporate life. She ended up in a very valuable career, which is medicine and health. But the first thing I learned when I was working at the bank was very fundamental, and that is how to look after my money. Now, you have to write this down because this is the first principle that people who don't have money, who end up without money, need to learn. Money is a tool, nothing more, nothing less. If you're smart, money is a tool that will make you smarter. But if you're an idiot, Money is just another tool to make you even more of an idiot. So money, you have to remember, is just a tool. Do you know anyone, but I mean anyone at all, who doesn't have enough money to live on? I know I wouldn't like to be that person, and I'm usually very troubled when I meet people who are in serious financial crisis, because people who get into financial trouble usually don't know and don't learn this one tool I'm going to be teaching you today. Let me give you a very practical example from my life. Those of you who know a little bit about me know that my core business is a furnishing business. So this was how I started my business. Now in this business today I employ about 24 people. 8 are blue collar, so they're delivery men, assemblers, warehouse attendants. Another 12 are in sales, and then the rest are administration. So the blue collar workers, much to the admin's dismay, insist that they get paid once a week. And do you know why this happens? It's because if they're not paid by the end of the week, and instead they're paid by the end of the month, like my father used to be paid, they would invariably come back to the admins of my business and ask for an anticipation of their salary, because they never make ends meet. Are these guys stupid? They're not stupid. Are these guys valuable? Definitely they are very valuable. Are these guys unable to budget? Most definitely. Neither them nor their spouses, partners, or whoever they live with are able to budget. So I picked this quote actually from Jim Rohn, and he says, if all the money in the world was collected in one pot and distributed equally amongst everyone, I can assure you that within a few years, that money will end up exactly in the same pockets where it came from. And this is why I tell you, money is a tool. Understanding that money is a tool and using that tool properly is the best way of making money, one, and keeping it, two. Money is exactly like a game on your phone. You need to know the moves, you need to know the rules, you need to know how to play it well. Otherwise, you'll continue making money and you will continue losing it. It's not about how much money you earn. Follow the but. It's not how much money you make, but how you get to keep your money. What will you do with your money is what really matters. So now I'm going to dive straight into the pillars of managing our money like the rich, and this is what I would really like you to understand. So first of all, you have to understand this very first important thing. The 5%, the 15%, the 80% rule. Now this rule is really important. It's based on CNN financials, it's based on Financial Times studies. So what I'm going to tell you is not going to be new. It's how we're going to use it to make best of it that's going to be really important. The 5%. So the 5% of world income earners are coming from what is known as generational wealth. So it means that these are the 5% who have inherited 5 million or more, or have created 5 million or more during their lifetime. And you know, it's mostly coming from old money. It's like generation pops, and it decays and they inherit. So for those of us who have not been blessed with the 5 million generational income, which we've inherited from someone else's hard work, we are going to be probably falling into the 15%, which is the 15% middle class. Who are the 15% middle class? These are the people who they own their house, they've paid off their mortgage, they have some savings, they go on a vacation. Basically, it's the comfortable life that unless we are like super ambitious to really go into the top 5% where we would really like to see ourselves comfortably in, right? And then we have the rest. We have the 80%. And this is where the 80% sit. Potentially, 80% of those of you who are following this course might already fall in this category, and we will do our best to make you climb into the 15%, right? What do these 80% have to look at into their future? Probably when they're older, they will have to remain working even beyond their retirement age, or else they are going to be dependent upon the government or someone in the family to subsidize their lifestyle. 80%. Can you believe it? 80% of the human population, even in overdeveloped countries, will fall in this category. So 5% is generational wealth, 5 million and over. 15% is comfortable, house paid off, little interest from investments, some passive income, no serious worries about money, net worth of 1 million, more or less, something like that. They would have bought their house 30 years ago, paid it off. You know, it would have been a real cheap price. Now it's really worth more. That's the net worth. They've put away some money in savings, buying some stock, like Warren Buffett, who's always buying Coca-Cola. He's not just drinking Coca-Cola, he's buying Coca-Cola shares because he believes that that is one business that will never go wrong. American dream by far. So these are the people that over time, their savings grow themselves into the 15%. But how many people do you know that even though they make a lot of money, because they have a behavior and a psychology that is wrong about money, will end up in the 80%? It's likely that there are many, and here is what I know. And if you are here and listening to this coaching session, you have what it takes to at least make it into the 15%, if not into the 5%. So I am going to go ahead and give you my business strategy that will potentially change your opinion and your value about money. Rule number 1. If you are in a business, you need to understand that the money in your till is not your money. Unless you're employed and you receive a check which is coming straight out of a system that has completely wiped out whatever taxes you need to pay, whatever insurances you need to pay, then that money, the money in your till, is not your money. Let me explain this. Let's say you have a brick and mortar business and you are selling clothes. And in one day you cash in, let's assume, $1,000. That $1,000 is definitely not your money. If I had to give a rough estimate of what proportion of that money is yours, I would say it's probably $100. I know you might be shocked about this, but this is the truth. $1,000 worth of goods. If you come where I come from, we have sales tax, which is around 18 to 20%. So automatically those 1,000 are actually 800 because you need to have a reserve account, which is for your sales tax, not income tax, sales tax account, which should always be there. And the minute you sell 1,000, you need to cut off, swipe off, hive off 20% of that money and put it in a separate account. Because at the end of each quarter, you are going to be called to pay that money, to pay that sales tax, to pay that tax element. So now you have 800. If you are buying clothes and reselling them, you have a cost to what you bought. Let's assume, for the sake of our argument, that the dress that you're selling for 1,000 costs you 400. So now we have 800 left from the dress. We have the cost of actually buying that dress because we will want to buy it again if we want to sell it again, which is 400. And now we are automatically left with 400. Do you see how it's going down? So now we have 400. 400, we need to deduct our marketing. Marketing, whether it's Facebook ads, whether it's public ads, whether it's paper marketing, social marketing, email marketing, whatever it is. That I would calculate to be around $100. And I say specifically $100 because your marketing costs are always more or less 10% of your actual sales, of your actual turnover, the money you turn over in your sales. It should never be more than that, and you should be very conscious of what you're spending your marketing on and how much you're actually spending, because it will throw everything out of proportion. We're building this formula, as you can see. So now we have 100 going away in marketing. Then we have our shop expenses. We have rent, we have water, electricity, we have cleaning, we have permits, we probably have an assistant. You tot all these up, and if you're lucky, so out of the 400, we took out 100 for marketing, and then we're probably going to have to take out at least another 200 for all the other expenses which are facilitating that we make this business. So boom, there we go. We are now left with around 100, 150. Now, if you're calculating this and you're left with 150, I would say you're very smart. But that is only smart if you have a company, an LLC, whatever it is that you pay where you come from. Because if you have a company, you have a cap on the amount of tax that you will pay on your net income, on your 150. Where I come from, it's anywhere, and mostly it's the same everywhere around the world, between 30 to 35%. So if you've earned 150, $50 are now taxed as income tax. So you are now left with a clean $100 bill. However, if you are trading on your personal account, that 150 could be taxed in as far high as 60%. So listen to this very carefully. If you are starting a business, you might want to feel it out on your own account, but at some point you need to get as much tax advice as possible so that you incorporate your business and you will go in a lower tax band. It's all legit, it's all done properly. But if you don't know about it, you will just be having being the happy taxpayer, because you will be paying a lot more tax than you're supposed to be paying. So are we clear on this? Are we clear that the money in our till is not our money? Now let's assume you don't have a brick and mortar business and selling something physically, but you're actually selling a service. The composition is very similar. If you bill a client $1,000, it means that you've probably really earned around 300, I would say. In a service industry, the tax base is immediately tax-based at 35%, so you're taking $350 out of the equation of the 1,000 you've earned. If you're based in a country where tax sales apply, then you need to remove the sales element. So from 1,000, you're left with 800, then you are taxed the 35% of the 800, which is practically another 800, and you're left with 500. Going too fast? I will put this on a board so you can see it visually, what I'm saying. So if you're left with 500, again, you're thinking of paying your office space. If you have an assistant, virtual or real, you're going to have to pay that. Again, water, electricity, some marketing, fees, expenses, what have you, and spot on out of the original 1,000, you are clearly going to remain with 300. Therefore, unless you receive a check payment from someone else who is administering all your tax and having everything factored in, including your insurances and what have you, your contributions, everything, and you receive a check that no one can touch, that becomes the actual money that you live on. Are we clear on this? And it's definitely a lot less than what you think you've made in the beginning. Rule number 2. As I said, if you're not employed by a government entity or a corporation that takes care of your taxes, you need to make sure that you are clear on whatever it is you receive. So, do you need a corporation? Yes or yes? Yes, you need a corporation. Call your accountant, make sure you see what your tax circumstances are, and make sure you get the benefit out of all the tax advantages you might have depending on how you're operating. This is really important because it will give you 1000% full control and clarity over what expendable cash you're going to have in your pocket. So rule number 2, make sure that you get your taxes organized. Rule number 3, your home budget. So now we've established that after some very hard work, sifting through the best tax benefits, you are going to be making, let's say, a clean 10,000. I'm obviously hoping it's more for everyone here, but somehow the 10,000 bracket a month sounds really good, and it's what we're all aspiring for when we are starting our business. It's like that 10K a month benchmark is the best sound when we're starting our business. So if you're getting 10 grand a month, it means that you can actually spend 10 grand a month, and this is your real spending money, right? Wrong. This is where the serious business of taking care of building ourselves at least to the 15% status will start. Remember what I said in the very beginning. Money is nothing but a tool, and it's a game, and we have to learn how to play it well. And it's really irrelevant how much money you're actually making, as it's more important what your attitude towards this money is, and it's really all about how you respect what you're earning. The game is how you're going to play your money well. So if you're going to have a check for 10K and you start spending it without playing with it, you're going to always end up in the 80%. That's the poor people bracket, okay? The bigger the check, the more poor people start spending. If you're not thinking about doing debt reduction, if you're not thinking of your pension fund, if you are only thinking, this is gratification time, this was really difficult to get this money, so now I deserve to spend it, overindulge, overspend, becomes a real roller coaster. So, here is what you do if you have respect for your time and your money. These are the topmost considerations that we need to have when we're looking at our personal income. So write this down in your notes, and first of all, write, now I have fully understood what is my disposable income, the money I can actually spend on life, on reinvestment, on whatever it is that I need to make my needle move. Number 1 consideration. Do you rent where you live, or do you have a mortgage? So you're actually paying off equity from your property. If you rent, you need to deduct the cost of the rent, which is the possibility of giving yourself shelter over your head. So I'm going to start planting the first seeds of doubt in your head here. If you're paying, let's assume 1K a month, vis-a-vis paying 1.2 or 1.3K a month in a mortgage, where will you be in 5 years? If you are paying rent in 5 years, there's a very good chance that your rent in 5 years will have increased exponentially. So let's not go into that detail, but we know for a fact it's going to increase. So you are paying a rent that is going towards the fund of those 15% who have been wiser and have actually invested in a second or a third property, which is rent for income. Buy to rent, rent for income, not pay rent, which is coming directly out of your pocket. This is the smart move that the 15% income earners do. So even if you're paying a mortgage and you never sell your property, you're actually contributing wealth, which will eventually go to your children or someone else and help them become part of that 5%. But if you have a place where you live and you're contributing towards the good borrowing, your life is already moving towards the 15%. The next rule I have to explain is the smart debt versus the dumb debt. And this is very important. So if you buy a property that today costs anywhere between 300, 500,000, whatever it is, and you're still in your 20s, your mortgage will probably be exactly the equivalent of a rental payment. Mortgage on a property is 2.5% interest. That is a smart debt. A credit card which is overdrawn, heavily overdrawn, with a charge of 9 to 10% is a very dumb debt. It's a very bad debt. Learn how to extend your borrowing with smart interest. Remember my sister? She, in 10 months, had completely forsaken her $1 that she used to borrow every single month from me. So now we've taken 1K out of the equation and we have a roof over our head. Next, we need to think of food, drink, budget. Clothes, medicine, budget. Insurance, budget. So what I would recommend at this point, and this is really important, is that you actually start journaling your expenses and keeping tab of what you spend on an average month. And just write it down. If you're going to be paying it in cash, write cash. If you pay for cash for your groceries, you factor them in. Or else, better still, use everything through a debit card. Mark my words, a debit card, not a credit card. Put your disposable income in a debit card so you can't pull out more than you have. This is the smartest move you can do to discipline yourself and to do proper budgeting. So if you're actually running all your transactions from a debit card, you will have a list of your expenditure every month. And this, to be honest, will vary from one month to another, but it won't vary that much. So you will have a very good idea of what you are actually spending. So journaling is really important. And then, how many of you enjoy having a holiday when they can make it? Women love the little baubles, the little diamond, the clothes, the bags, the shoes. We all love to have this stuff. But if you're going to give priority to this stuff over owning a property, what are you going to end up with? A bunch of very nice stuff and a rented apartment. You get my drift? So when you get this 10K check, you enjoy it for a week and then you start scaling before you get another 10K check and you're always out of money? Or are you starting to build a nest egg, which should be a lot of different funds? And this is the rule number 5 that I am going to teach you today. We should care for our disposable income. Now, I'm assuming at this point that you've all understood the relevance of having a disposable income, meaning it's the money that after paying all your business expenses, those of you who are in business, those of you who are in service industry, have paid all the taxes and everything. And this is the money that you can actually take at home. It's the home money net of profits. So now I'm going to reverse engineer the statistics. And now I'm going to have the 80-15-5 rule. So let's say we keep on the example of having the 10K, hypothetical, that you need to have as your disposable income, and the percentages of wherever it is that you're earning will all work the same. That's why I'm using the 10K mark, because it's easier to understand. So we start with the 80-15-5 rule. The 80 is what we've already established goes into the life we're living. So the real stuff we need, the roof we need to have on top of our heads, the clothes we need to buy, the medicine, the electricity, basic clothing, whatever our kids need, education, all the stuff that you've journaled. 15% needs to go into a retirement account, because unless you realize wherever you come from, the government will only give you around 50% of what it is you're actually earning today and what you're contributing, or else if you don't have government pension funds, any pension fund really and truly will give you more or less half of what you're actually earning today. So you need, if you want to remain having the same lifestyle as you have today, you need to put away at least 5 of that 15% into a retirement plan. 5% should be cash to buy real estate, buying your second property, investing in bonds, investing in stocks, investing in shares, investing in crypto. Whatever your risk appetite is like, you should always allow for 5% of that 15% to go into a fund which will keep growing into more funds. Now, this is something I learned very interestingly when I started in the very early years of my banking days. At the time, they used to pay very high interest rates. But what I knew from what I learned then, and this you can work it out, is that if you put away $100 at 12% compound interest, the power of compound interest. So what compound interest really means is that you put this money and you get paid interest, but you don't take it, you add it back to your capital. Believe it or not, $100 at 12% interest, if you don't touch it for 6 years, becomes $200. And then another 6 years, those $200 become $400. And those 400 in 6 years will become 800. And this without ever needing to contribute any other single cent. So learn how to save and invest in something which gives you a high return of profit, and don't touch it. Let it go compound interest. The third one is the rest of the 5%. The 5% that's left. And this is your final option. And depending on where you are in your life, this is your give back money. Use part of this income to either give to charity, because there are a lot of people who need it a lot more than yourself. And what does this do to you? What it will do is it will create the abundance mentality. When you create the abundance mentality and you give, you will grow mentally exponentially. And then you will be able to create an imagination that creates more wealth. You will work more smart. You will be able to attract the universe to work in your favor. When you give, you get. Grow your mind. If you're still young and you cannot understand the importance of creating this abundance mentality by giving, then you should be investing in yourself. Use that 5% to get yourself a coach, to get yourself a mentor, to read amazing books by people who have already succeeded, because that's the only way you will grow your mindset into understanding how to grow financially independent. What action are you going to be taking in the next 30 days that will revolve around this module, this information today? Text financial freedom, send me an email, send a message, text on the post box below, and let me know if you need more information about this, if you need more help. I am ready to do this on the one-to-one coaching sessions that I do with everyone who reaches out. But you must be totally clear. What will you do in the next 30 days that is going to improve your financial stability, that is going to lead you to the path of financial freedom? Thank you very much. Remember the 80-15-5 rule at the bottom and the 5-15-80 rule. You decide which percentage you want to be in. And hey, before you go, if you've enjoyed this video, please share it with someone who can get some benefit from it. And better still, subscribe to my YouTube channel so that you will be able to get updates on the weekly posts I make, which will give you a lot of financial freedom, mental freedom, growth, mindset, and most of all, business growth. Thank you very much.